Hello and a warm welcome to Portfolio Watch. I'm Gugulethu Mfuphi. And our topic today is China and Japan. Now, while Japan might have had a rather lackluster past 3 decades, China has certainly turned itself into a domestic-led economy through copying, innovation and creativity. By the year 2030, China will be equal the US economy, followed by Japan. Now, to touch on these huge opportunities that exist in these unique Asian markets, I'm joined in studio by my guests, Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Lance Williams, Managing Director at iCapital. Gentlemen, great to have you with us today. Perhaps I should be saying ni hao, but that's as far as my Mandarin actually goes. Let's actually pick up on understanding the macros, right, regarding both China and Japan. And I know China, of course, for many, well familiar with regard to the market, with regard to its growth opportunities. Japan, though, I understand, Andrew, we shouldn't pass a glance at, but actually really interrogate the investment case.
Yeah, so I suppose Japan, is a country that we haven't really spoken about for a long time, given, what happened, I suppose, the economic miracle that was Japan through the 70s and 80s that very quickly, disappeared with asset prices coming under immense pressure, towards the end of the 80s. I suppose we could argue now they were in bubble territory, and you ended up with this lost decade, whereas today the Nikkei hasn't even recovered to where it was, at its heights at the end of the 80s. So if you had invested at that time, you're still underwater essentially, almost 30 years later.
Sure.
So it resulted in this lost decade, which then became lost 2 decades. And now investors have kind of just pushed it to the side because, there's been this deflationary environment, the economy's, been in and out of recession over this time period. But if you start looking, what's happened recently, specifically over the last 5 years, Japan starts to suddenly look rather interesting from an investment point of view. The economy has returned to growth over the last 5 years. I think it's grown about 12%, over that period. If you look at the stock's actually outperformed, over this period, outperformed the likes of the US and Europe, which not many people, realize. We can talk about valuations, we can talk about the companies,
Sure.
What's going on in the stock market there as well. But, overall, I think, we should stop forgetting about Japan, and Japan should be back, squarely front and center of an investor's investment universe.
Given the numbers that you quoted, we know that who we have to thank for all of these developments is Shinzo Abe, given Abenomics and what he's trying to instill there. But with that said, is it still a very long-term story? And perhaps by long-term, we need to redefine what that is, because clearly 3 decades might not be enough for the average investor. But are there competitive dynamics still worthy for us to look into?
Yeah, absolutely. I think if you think about long term, I know a company we're going to talk about is SoftBank. He's got a 300-year strategy. So the Japanese are very much long-term focused. When it comes to investing. If you think of what's going on there, they've got this aging population. So they're really they're very excited about automation. They're embracing automation, where a lot of the Western countries are fearful of automation because of the displacement of jobs. They need to increase their output, given that their labor force is declining faster than what other countries are. They've got an old population. So I think there is a very long runway. Then when you look at, if you think of the individual companies, from a corporate governance point of view, has always been an issue, for Japan going back. Their corporate governance have had a lot of, corporate scandals over the years. They've cleaned this up. Now they've got a corporate governance code. Pakistan had a corporate governance code before Japan did, interestingly enough. But there's also a lot of opportunities in that Japan has more listed companies, for instance, than the US does.
Sure.
So there's huge opportunities. They're embracing, this new tech. So I do think there's a long runway for what I would consider a long-term investor, and when we think of long-term investing, not the 300 years that SoftBank might have, but you're looking 5 to 10 years. Looking
at a more substantial amount of time, no doubt. One of the other peers, especially in the Asian space, is certainly China. We understand how great their dynamics are. So much surplus cash that we've actually been some of the beneficiaries as South Africa, given their investments following the BRICS summit. Lance, let's start with you, giving us your quick overview on China, and Andrew, feel free to share.
So China is interesting because it's very front and center of world news currently with this trade spat with America. So I don't think you can overlook that. Yes, it's a massive rise, and that is squarely continuing. But more recently, it's hit a few bumps in the road, unfortunately, mainly because of this trade spat with the US and with President Donald Trump. I think you can't overlook the change in geopolitics as a result of a change in presidency coming from the Democrats to the Republicans, and Trump especially. He's almost, you would say, at a sort of more right, center-right And that really, this America First is putting a big spanner in the works about the quite cozy situation we had. China, the producer for the world, quite cheap, going into developed economies, and then changing their economy also into a consumer-driven economy. And that sort of was a nice, almost like a relay race, handing the baton over to the other side of the economy and creating its own growth. That's still quite firmly entrenched, but it was at such a pace that anything could hit it, and this trade spat has really caused the Chinese economy and the very rosy outlook for Chinese stocks to come unstuck. And we'll talk about the stocks in detail later, but the Chinese stock market itself is near 2-year lows. So it's really feeding into the economy and therefore into the markets, and the world is feeling it. Quite interesting, Xi Jinping, the president, also quite authoritarian, more so, and that's also worrying people. Very nationalistic, quite forefront of foreign politics, but quite authoritarian, and that may cause the Chinese growth story to slow a bit as well.
Sure. Andrew, your thoughts here? Because whenever we think about China as well, they're also known for being a significant contributor to all things technology, innovation, and of course, given the population size there, half the phones that they make are already consumed in their own market, right?
Yeah, so I think from a IT point of view, they've never really been that strong on hardware development. They've lagged from that perspective. But when it comes to software, innovation, artificial intelligence, I mean, you know, they are probably the world leader. I'll say probably the US might argue that, but they are definitely up there with the world leaders. And you can just think of some of the companies that they've produced, you know, and we'll talk to some of them, but Alibaba, Tencent, Baidu, etc. You know, these are global IT world leaders. So they definitely lead from that perspective. But I do agree with Lance that there's a couple of headwinds that they face. And economic growth is always important to look at, because in the long run it turns into corporate profits, which ultimately...
Do we trust those numbers though? That's another contentious issue with China, right?
You know, so it flows from economic growth, corporate profits, and into returns, whether we trust the numbers or not. What we are seeing is that those numbers have come under pressure. You know, so this is, I suppose, the economic miracle that China has been, you know, has been a long-term story as well. Started, you know, reform started in the 70s, so it took 20 years for to eventually materialize. And you can't just build roads to nowhere forever, you know. So the investment, you know, led growth now has to become consumption-fed, which we've seen slowly. And I suppose the big question is, can they continue to grow at, I wouldn't say 8-9%, but 5-6%. You know, and to do that, their consumption growth has to grow at, you know, between 6 and 8% going forward, and that's the key question. And they are, you know, there are banking reforms, you know, medical aid reforms, pension reforms, etc., minimum wages that are put in place to try and help the consumer. But there's also the question mark around their debt. How do they handle that? They do believe they can handle it. So there are a couple of headwinds, but I'm still very much a firm believer of the long run Chinese.
Well, we're still optimistic, and of course, with all this excitement around both Japan and China, we're certainly looking for enhanced investment opportunities for us as investors. Let's take a look now at some of the stock picks to run through. For the average South African, they think investment opportunity, Naspers, Tencent. But we're going to go a whole lot broader today on this. And I understand SoftBank is one of those that features top of your list, Andrew. Who are they? What do they do? And what are the investment fundamentals here? Yeah,
so SoftBank's a very interesting business. It's an investment holding company. Masayoshi Son is the CEO of the business. He's the richest. He's the Warren Buffett of Japan, the richest man in Japan. And he's got a very long-term track record. You know, if you look what he's invested in, he's had the ability to pick up these inflection points from when growth turns from linear to exponential. So if you go back to the 70s with the onset of the PC, you know, he built a software distribution business. Then he foresaw, you know, how the internet was going to change. He had a meeting with Steve Jobs to speak to him about the iPod and put
back
in
the 70s?
You know, no. This came later.
Sure.
The PC was the 70s, but he spoke about, you know, how do we take this iPod, put the keypad on it, and it becomes our phone. You know, so he foresaw, you know, your mobile smartphones. The Internet of Things. He's in the last couple of years invested in ARM, which is the semiconductor business. He bought a gaming business in 2013, Supercell. which he sold 3 years later to Tencent, funny enough, for about 3 times. So he saw the online gaming, given the power of mobile phones, mobile apps, etc. So he's one of these thinkers. So an investment in SoftBank, I think, is an investment alongside Masayoshi Son. 50% of the market cap, however, is made up of Alibaba. He owns about, I think, it's about 28% of Alibaba. But he bought this back in the 2000s when he foresaw e-commerce coming, online. So he's one of these forward thinkers, exponential thinkers, and investing in SoftBank. They're doing a huge amount in autonomous driving now, artificial intelligence, that sort of thing. So he's hoping to uncover the next Alibaba. Very similar to Naspers, Tencent. Get in there early, and you get one of these businesses that sit up. Nvidia is another company that is heavily invested.
And ride that J-curve in growth
so
potential.
It's a very interesting story. It's not necessarily Japanese specific, because you invest in very much outside of Japan, but it's Japanese listed.
On Alibaba, I also know that, Lance, you're quite a fan of Alibaba and, of course, the growth opportunities there.
Yeah, so Alibaba and SoftBank is a very story to Naspers and Tencent, interestingly. But Alibaba is an unbelievably powerful retailer. It is the world's largest retailer. Not many people realize that or know that. It cuts right through the whole distribution chain for retailing. So it has a big consumer-to-consumer business, it has a big business-to-consumer business, and a big business-to-business business within internet portals, all under different names. Alibaba is the main name, but then they have subsidiary names, and it really is massive. It created something called Singles Day, which is pretty well known now. It's in November time, and last year it generated over $20 billion of sales on that single day. So it really is a internet retailing giant. Moving into artificial intelligence, as Andrew says, it's quite a strong theme, and a lot of these internet companies have taken a venture capital approach as well. So part of their R&D really is venture capital, where they have a pot of money and they will be investing in other smaller internet companies that they see. The Internet of Things is very big. Autonomous driving is a big theme. So all playing off these themes. The founder of Alibaba, Jack Ma, very charismatic entrepreneur, recently launched a $10 million entrepreneurship fund for Africa, which has been quite topical, pushing entrepreneurship in Africa. The view is that South Africa as a country and our leaders could learn quite a lot from him. To try and get that going, because that's what every developing economy needs. Quite
right. He visited our shows not too long ago to hopefully provide some insight on that. Lots more stocks that we're certainly going to run into. For the moment, though, let's take a quick ad break. Welcome back. You're still watching Portfolio Watch, and our topic today is all about the excitement surrounding Japan and China as two powerhouse economies that we need to monitor for some strong investment opportunities too. Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Lance Williams, Managing Director at iCapital, join me now as my guests to give us more insight into some of the stocks that we can touch on and invest in both these markets. Gentlemen, we did touch on SoftBank as well as Alibaba before the ad break, but what about Fanuc? I understand they're into robotics, right?
Yes, I think they're the world's leader in robotics. So if we think about the world that we're moving to, automation, and we spoke about Japan earlier and how they embrace automation. Fanuc's a Japanese business that builds robots, that automates vehicle manufacturing, processing lines.
Are these the guys who are threatening to take our jobs with all the rage around the fourth industrial revolution?
So if you think of the runway that there is to go, when you look at the two major manufacturing areas, being the US for car manufacturers and mobile phones, and China, I think there's huge growth potential in this business. It's, when you look at it, they're obviously not the only one that's doing this. There are competitors, but how they distinguish themselves from their competitors is that they build a standardized robot. They're not, some of their competitors will go to Toyota, for instance, and build a robot specifically for Toyota, which obviously incurs a huge amount of costs. Fanuc develops a standardized robots, that they can use across, different products. And as a result, it reduces your operating costs. So when you look at their margins, it's 33%, which is well ahead of their peers. You know, from a return on invested capital, it's about 3 times their cost of capital. And then, you know, what really gets my attention is if you look at the balance sheet, this is a 4 trillion yen business. I don't think it's 4 times the size of Apple. Okay. If you convert that to dollars, it's about a $40 billion dollar market cap. But if you look at the balance sheet, there's 0 debt on the balance sheet, and they've got about $10 billion worth of cash. So they've got about 25% of the market cap just sitting in cash on their balance sheet, which is also quite interesting.
Sure.
You know, so it's I think it's a great, makes for a great investment case.
Great investment case, Lance. You certainly agree?
Yes, it's rated quite highly for the growth that Andrew mentions. A nice yield where they've got their cash flush. So if you believe in the future automation, and I think that is a trend, yes, a decent investment.
So, WH Group, who are they? What do they do?
So this is a Chinese business. WH Group, yeah, it's not a company that everyone knows, specifically in South Africa, but it's the world's biggest producer of pork. And it's a Chinese listed business. Yeah. And
no listeriosis in that market, is there?
Swine flu, yes. One of their facilities just been closed because of African swine flu in China, interestingly enough. So it does have those problems too, yes.
Yeah, so and there has been a few, you know, over time, a few question marks of, you know, products that have been injected into the meat, etc. Yes. So US at one stage actually banned them exporting pork from China into the US. So what they did, they went and bought a US pork producer. They've bought recently Smithfield, which is a UK pork producer. And now the pork flows the other direction from the US back to China. We know that, you know, the Chinese consume huge amounts of pork, probably 100 times more than any other nation. When you think of their population of 1.4 billion. You know, so this plays directly to that theme. So when you think of China, and we spoke about, you know, AI, IT, you know, your Tencents, etc., you know, these companies and WH Group in particular plays to the agricultural theme, which is also a very, very important theme when you think of growing populations, land scarcity, etc. So, you know, again, this, I suppose, another great investment.
Yeah, and so this is almost on the other end of the spectrum because you can't digitize food. So it's really, people will continue to eat, and this is a play on that. Recently, a bit hurt by the trade spat. A third of its sales are to the US, so caught up in that, and very cheap as a result. It's a strong buy, 10 PE and a yield of 4.5%. So this is deep value, if you're looking for deep value and in that play. So it's on the cheap side of things.
Well, we know with consumers, they need to eat, but they also need to drink, right? And this is where multi, I understand, that comes into play. And you had an interesting experience, Andrew, on your recent trip to China. I understand quite expensive, just for what, 500 milliliters?
So multi, yes. It's about a 3,000 Rand for a 500 ml
Say bottle. That again, 3,000 Rand, when you translate it into
so it's not your cheap, you know, 100 Rand bottle of vodka that you might get down the road here, but it's a white spirit. So it's called Beiju is the spirit that they sell. You know, Motai. So not many people would have heard of it, but they are actually bigger than Diageo. You know, it's the world's biggest you know, liquor distillery. So we're not comparing it to your breweries like Anheuser-Busch, and it sits between Anheuser-Busch. I think it's about $150 billion market cap. So it's a big business, huge pricing power. When you think of the brand, and if they can charge those sort of prices, you know, so from a brand point of view within China, this is the ultimate drinking spirit that everyone strives for. It has been hurt in recent years with the government clamping down on the anti-extravagance. So that has hurt it a bit. They do also, you know, it's also a bit of a game between supply and demand. So they cut back supply, you know, in recent years, and now they're hitting supply constraints. So they're having to see more supply coming online. But you know, for the long-term story, when you're looking at the revenue growth rates that they've seen in recent years, they've done exceptionally well.
Very good return on capital and good margins, as Andrew mentioned, and is a good example of a shift in the trend of the world when the old paradigm of the West is now becoming more influenced by Chinese influence, and this is very much a play on that. And you see the incredible rise in the spirit Baiju and the demand for it globally, not only in China.
Baidu as well is one of those stocks that certainly comes up here. Is this also linked to Moutai slightly, or a different environment completely?
No. So this is Baidu, not to be confused with Baidu.
Oh, okay.
Which Baidu is the Google of China, I would guess. That's how you could summarize Baidu.
It's a tough competitor to Tencent as well, perhaps.
Yes, they play, but in a similar space, but very much internet focused. So search engine principally, and as I mentioned, really very strong comparison to the Google around the world. I think the big difference is that Baidu is China-centric. And it's almost built in because the fact of censorship in China. So Google has 10% market share in China. They recently re-entered the Chinese market after leaving, and that really hurt them. So they're obviously anti-censorship, and Baidu are squarely at the forefront of Chinese search. And Chinese is such a big market in China in itself that they're a very big business, 100 billion market cap. Just in that space. Then also very similar to the other companies where they are in AI and other aspects of venture capital investing in that space, in the technology space within China and globally.
So strong investment fundamentals here, one that we like, even though it's quite a competitive environment there. You agree, Andrew?
Yeah, absolutely. I mean, if you think about the number of Chinese people and how much time they spend on their phones, it's something that struck me when I was in Hong Kong in April, May, is that these Chinese consumers, call them, spend their lives on their phone. On average, they spend 5 hours a day, looking at their phone.
Oh.
So these ecosystems that not just Baidu but the likes of Tencent as well, it plays straight towards that. And you're sitting in a taxi, and the navigation system, is run by these businesses. So it's touching everywhere. Your pay systems. So yeah, I would strongly agree with Lance on this one.
And that speaks to the content, it speaks to the data services, and most importantly, the devices themselves, right? And if they're not using Apple or Samsung, I understand that they're using another one, which has clearly risen up quite significantly up the ranks.
Xiaomi. So not well known in South Africa, but hugely popular in China.
How do they rank, by the way, from a global point of view? Because we think Apple and Samsung are the greatest mobile phone operators.
They're the 4th largest smartphone maker in the world, Xiaomi. Recently entered South Africa, so you will find their phones here. So interesting enough, Samsung are the biggest by far, and then Huawei has overtaken Apple in terms of number of units, and then you have Xiaomi and being number 4. Recently listed in July, quite an interesting listing process they went through, and the listing has been quite disappointing, where you've seen these big increases on listing. You have not had that with Xiaomi, and I think that's indicative of what's out there in terms of what I spoke of earlier of the Chinese stock market, really flat to down because of the trade spat. Xiaomi very strong in the Internet of Things and this ecosystem, as Andrew spoke about, trying to encapsulate a whole ecosystem of internet-enabled devices controlled really through your mobile. So the computer is in the hand now, and you find these companies with massive ecosystems around that, and they're all trying to capitalize on that.
So huge opportunities and great numbers there, no doubt. But I think for the average retail investor like myself, when we think about investing in Japan or China, there's a slight sense of anxiety, right, or angst with regard to understanding the market and really getting opportunities in there. What are some of the conversations you have with clients to, intrigue them about the investment opportunities in both these markets? Yeah,
it's a very good point. So the focus of what I would say is you've got to look at companies that have a global reach. Japan, we spoke about the local economy, not great because the demographics are so weak in that country, but there are incredible companies within there that are going to be global giants and are already global giants, and the same with China. If you want to look at these businesses, Alibaba, for example, is global. These are global businesses. Tencent with WeChat is a global business, very strong in South Africa as well, and up there against the traditional FANGs, which are the internet stocks which are more Western based.
Yes.
Facebook, Apple, Netflix, and
which
Google.
Which we're familiar with because we interact with them, right? Exactly. Which makes it easier to want to seek investment opportunities in those markets. Andrew?
Yeah, I'd say it's a strategic imperative that you have, exposure to China in your investment portfolio. Whether you do that directly or indirectly, look, a lot of these businesses are listed in the US through the ADR program, but typically or historically investing in China has been quite difficult because they've been very closed. And if you think that China's the second biggest economy in the world, if you actually look at how much it constitutes the global MSCI World Index, it's very small. And they're slowly starting to open that up. So we've seen its inclusion in the emerging markets index recently, and that should start to open up the Chinese stock market and make it easier for foreigners to invest. There are other ways you can obviously invest through Hong Kong. They've got the Connect program as well, but historically foreigners haven't or have found it very difficult to access that market.
Makes sense. But clearly this is why we have conversations like this on Portfolio Watch, to make sure that we warm up to the gems that have been spotted in our Asian counterparts. Well, a big thank you for tuning in and joining us this evening. I think the correct Mandarin term is what? Sheshe? Well, we'll practice and get it right one day, hopefully. But a big thank you to you for watching, and of course Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Lance Williams, Managing Director at iCapital. We look forward to hearing your thoughts and suggestions, so tweet us at CNBC Africa using the hashtag #PortfolioWatch, or email your questions to portfoliowatch@abn360.com. From myself and the team, have a fantastic week.